Hey everyone, this is Jeb Graham with Metcalf Partners Wealth Management, and this is a Metcalf Money Moment for this week. First and foremost, hope everyone had a wonderful Thanksgiving and a happy holiday season to you coming up. The biggest question that we've been getting from a lot of clients lately is whether or not we believe the U.S. is getting ready to go into a recession. What I want to talk about today is a recession indicator that's called the inverted yield curve, and I also want to talk a little bit about why that's important. I'm going to start by why that's important. An inverted yield curve has predicted every recession since the late 1960s, and there's been 8 of them. So, on all 8 of those recessions, it has been preceded by an inverted yield curve. So, what is an inverted yield curve? Let's first start talking about bonds when we're talking about an inverted yield curve. If you think about bonds, you have short term bonds and you have long term bonds. Typically, a long term bond is going to demand a higher interest rate than a short term bond. So, an inverted yield curve is when the short term bond is actually paying a higher interest rate than the long term bond. The reason a long term bond demands a higher interest rate is because you're locking your money up for a longer period of time. A good example of an inverted yield curve would be when the 2-year Treasury is paying a higher interest rate than the 10-year Treasury. Well, right now we're in a position where the yield curve has been inverted for over a year. So that's a pretty good indicator that at some point in the near future, we're going to go through a recession. So what does that mean? Does that mean the stock market's going to crash or we're going to go through some really horrible economic period? Not necessarily. It could be a shallow recession, or in turn, it also could be a deeper recession, and we don't know that. But what we do know is a lot of times when the yield curve is inverted and we're going into a recession, we could go through a bull market in bonds and we could go through more of a bear market in stocks. A lot of times bonds are going to perform better in that environment than stocks are going to. And what we also know is that when we do get to the other side of a recession, if indeed one does come, that also means that we're going to go into a new expansionary period in the US economy that hopefully will last for a good long time. This has been a Metcalf Money Moment. If you have any questions, please don't hesitate to reach out.